6 a.m. Eastern. Silver just hit $100 per ounce in overnight trading. By noon, 3 major banks will be insolvent. By close, the government will announce emergency measures. This is the hour-by-hour breakdown of what happens the day after silver touches 100. Let me walk you through the cascade. Every hour, every decision, every failure. Because this isn't speculation. This is what the models predict when you input $100 silver into the derivative exposure equations. This is the mathematical outcome that banks are desperately trying to prevent. 5:47 a.m. Eastern Time. Silver futures in Asian trading session break through $98. The momentum is unstoppable. Physical demand from China has overwhelmed paper selling. Industrial buyers are panic buying whatever they can source. Mining companies are defaulting on forward contracts. The price breaks $99 at 5:51 a.m. 5:58 a.m. Silver hits $100.02. Trading volume explodes. The $100 barrier that banks defended for years just broke. Somewhere in New York, risk management systems start flashing red. Automated alerts are triggering. Risk officers' phones are ringing. The banks have 6 minutes before markets open in New York. 6 a.m. Emergency risk meetings begin at JP Morgan, HSBC, and Bank of America. They're calculating margin requirements. At $100 silver, JP Morgan faces $12 billion in margin calls. HSBC needs $8.4 billion. Bank of America requires $6 billion. And they need to post this collateral before New York market open at 9:30 a.m. 6:23 a.m., the Federal Reserve gets its first call. JP Morgan's CEO is on the line with the New York Fed president. The conversation is brief. We need emergency liquidity. We need it now. If we don't have $12 billion by market open, we're going to start failing derivative contracts. 6:41 a.m. HSBC's London office is in crisis mode. The bank is scrambling to find $8 billion in liquid collateral. They start selling positions. UK government bonds, German bunds, blue chip stocks. Anything liquid gets dumped at market prices. But selling $8 billion in 3 hours moves markets. Bond prices start falling as HSBC liquidates. 7:15 a.m. Bank of America begins liquidating its stock portfolio. They need $6 billion in collateral. They start selling Apple, Microsoft, Tesla, Amazon. Their entire equity book gets marked for liquidation. The sales won't hit the market until NYSE opens at 9:30, but the orders are already placed. 7:48 a.m. Smaller banks start reporting problems. Regional banks with silver derivative exposure are calling their clearinghouses. Margin calls are cascading through the system. It's not just the big three. Dozens of institutions with silver exposure are facing calls simultaneously. 8 a.m. COMEX issues a statement. Due to extraordinary market conditions, silver futures margin requirements are being increased by 34%, effective immediately. This is their standard playbook. Raise margins to force liquidations and bring prices down. But this time, it backfires. The margin increase triggers more forced selling of other assets to meet silver margin calls. 8:23 a.m. The first hedge fund blows up. A commodity-focused fund with large short silver positions gets a margin call it can't meet. Their prime broker starts liquidating positions. The fund had short positions across multiple commodities. When those positions get closed, it pushes commodity prices higher across the board. Gold spikes. Platinum jumps. The contagion is spreading beyond silver. 8:47 a.m. Physical silver dealers report unprecedented demand. Online dealers have no inventory. Their websites show sold out across every product. Phone lines are overwhelmed. Premiums over spot are already at $15. Physical silver is trading at $115 when paper silver is at $100. 9 a.m. The Treasury Secretary gets briefed. The situation is critical. 3 major banks are facing capital stress. Smaller institutions are failing. Commodity markets are in chaos. Stock futures are down 4% in pre-market trading because banks are liquidating positions. The secretary has 30 minutes to decide on intervention before markets open. 9:15 a.m. Federal Reserve announces emergency lending facility. Banks can borrow against silver derivative positions at 90% collateral value. This is designed to prevent immediate failures, but it's not enough. The banks still need to post margin to exchanges, and exchanges don't accept Fed liquidity as collateral. 9:30 a.m. New York Stock Exchange opens. Chaos. Bank of America's liquidation orders hit the market. Apple stock drops 8% in the first minute. Microsoft falls 7%. The Nasdaq is down 6% within 5 minutes. Circuit breakers are triggered at 9:34 a.m. Trading halts across all exchanges for 15 minutes. 9:45 a.m. Trading resumes. The selling continues. HSBC's bond liquidation is pushing Treasury yields higher. The 10-year Treasury yield jumps 40 basis points in an hour. This is causing losses for every institution holding bonds. The crisis is spreading to fixed income markets. 10 a.m. Silver futures market halts trading. Price hit limit up, $112. The exchange can't handle the volatility. Physical markets are completely disconnected. Dealers who have any inventory are asking $130 per ounce. But there's no inventory. It's all orders, no supply. 10:23 a.m. First official bank failure. A regional bank with $28 billion in assets can't meet margin calls on its silver derivative book. FDIC takes control. Deposits are protected, but shareholders are wiped out. The bank's stock falls from $32 to $1 in seconds. 10:41 a.m. Credit markets freeze. Banks are so focused on raising collateral for silver positions that they're not lending to each other. The overnight lending rate spikes from 5% to 14%. Money market funds start seeing redemptions. The 2008 playbook is repeating. 11 a.m. Emergency congressional briefing. Federal Reserve Chairman explains the situation to Senate Banking Committee in closed session. 3 systemically important banks are facing capital stress from silver derivative exposure. We're providing liquidity support, but if silver stays above $95, we may need legislative authority for direct capital injections. 11:23 a.m. Mining companies are defaulting on forward contracts. They sold their future production at prices below $100. Now they're required to deliver silver at $70 when spot is $112. They don't have the cash to buy silver at market to fulfill contracts. Bankruptcy filings start hitting the courts. 11:47 a.m. Corporate industrial users announce production halts. Electronics manufacturers can't source silver at any price. Solar panel companies are shutting down lines. Electric vehicle production is being suspended. The physical shortage is starting to impact the real economy within hours. 12 p.m. President addresses the nation from the White House. We are taking emergency measures to stabilize commodity markets and ensure the integrity of the financial system. I am signing an executive order creating a strategic silver reserve and authorizing the Treasury to purchase silver on behalf of the government to stabilize prices. 12:15 p.m. Markets rally briefly on government announcement, but the rally fails. Silver is still above 100. The banks still face margin calls. Government purchases won't come fast enough to solve today's crisis. 12:47 p.m. Second major bank failure. A bank with $43 billion in assets can't meet its derivative obligations. FDIC takes over. This one is bigger. The failure triggers counterparty concerns. Who else is exposed? Which banks have derivative contracts with the failed institution that won't get paid? 1 p.m. Silver trading remains halted on major exchanges, but off-exchange trading shows silver at $118. The disconnect between paper markets, halted, and physical markets, soaring, is complete. People are trying to buy physical and finding nothing available at any price. 1:23 p.m. Mutual funds start gating redemptions. Funds with significant bank stock holdings or commodity exposure are preventing investors from withdrawing. They don't have enough liquidity to meet redemptions if everyone tries to exit at once. Your retirement account in these funds is now frozen. 1:47 p.m. International markets react. European banks with silver exposure face their own margin calls as European trading sessions continue. Asian markets are already closed, but futures trading shows they'll open down 8 to 10%. The crisis is going global. 2 p.m. Federal Reserve announces unlimited liquidity support for banks facing silver derivative stress. This is the whatever it takes moment. The Fed will lend unlimited amounts against any collateral to prevent bank failures. But this is money printing. The dollar starts falling against other currencies. Gold spikes to $3,200. 2:23 p.m. Pension funds report massive losses. CalPERS announces preliminary losses of $8.4 billion from silver derivative exposure and bank stock holdings. Teacher retirement funds across multiple states are reporting similar impacts. Your retirement just took a hit, even if you don't own silver. 2:47 p.m. Physical silver premiums hit $30 over spot. A 1-ounce silver coin that should cost $112 based on futures prices is selling for $142 in the few transactions that are occurring. Most dealers aren't selling at all. They're waiting to see where this goes. 3 p.m. Third bank failure. This time it's one of the original three, smaller than JP Morgan, but still systemically important. The bank's derivative book was larger than its capital base. FDIC takes over. This is the first time a top 10 U.S. bank has failed since 2008. The stock market drops another 3% on the news. 3:23 p.m. Emergency measures expand. Treasury announces unlimited purchases of bank-preferred stock. This is direct capital injection. The government is bailing out banks using taxpayer money to cover losses from silver derivative positions. The political fallout will last years, but right now they're trying to prevent total collapse. 3:47 p.m. Silver futures trading remains halted. Exchanges announce they won't reopen silver trading today. They're citing extraordinary conditions requiring extended halt to ensure orderly markets. Translation: they can't handle the volatility and they're buying time for banks to stabilize. 4:00 p.m. Stock market closes, down 11% for the day, the largest single-day drop since the 2020 COVID crash. Bank stocks are down 20 to 40%. JP Morgan down 23%. Bank of America down 37%. Regional banks down 50% or more. 4:23 p.m. After-hours announcements begin. Multiple banks disclose material derivative losses. Credit rating agencies place 6 banks on negative watch. Moody's downgrades 3 banks immediately. The credit crisis is accelerating even after markets close. 5 p.m. International emergency calls. G7 finance ministers hold emergency video conference. Every major economy is facing similar stress. Banks in London, Frankfurt, Tokyo all have silver exposure. The discussion is about coordinated intervention. Should governments ban silver exports to keep metal in domestic markets? Should they suspend derivative trading entirely? Should they force cash settlement of contracts instead of physical delivery? 6 p.m. Evening news coverage. The crisis dominates every channel. Reporters are calling it Silver Tuesday. Comparisons to 2008 financial crisis and 1929 stock crash. Analysts are predicting 2 to 3 more bank failures before the week ends. Protests are starting outside Federal Reserve buildings and major banks. 7:00 p.m. Asian markets prepare to open. Japan, Hong Kong, Shanghai, Sydney will open in hours. They're going to open down hard. The crisis is going to play out again in Asian trading sessions. Futures suggest 8 to 12% drops across Asian indices. 8 p.m. Silver still above $100 in after-hours off-exchange trading. The government intervention hasn't solved anything. The physical shortage is real. The derivative exposure is real. The banks are wounded but not dead yet. Tomorrow will bring another round of margin calls, more liquidations, more failures. This is day 1 after silver touched 100. Day 2 begins in 10 hours, and the banks have no idea how to stop the cascade.